Hi, Lee Phillips here. Yeah, I'm a lawyer. Don't hold that against me. We're having fun on these YouTube videos, though. I enjoy them. Hope you enjoy them. I want to talk about how you physically make a gift to children or whoever through a company. It's not unusual to say, okay, I'll do the gift, but I don't want the kids to really control all this money or this equipment or whatever it is. So I'm going to set up a corporation, an S Corp. I'm going to set up a family limited partnership. I'm going to set up an LLC, and you can have it taxed however you want. That's another YouTube video. Taxation of an LLC. But how do physically I make this gift to the company? And you have to do it right or it doesn't work. It's not a gift. Because one of the elements of a gift is when the person receiving the gift gets it, they have to have full control over that gift. They have to be able to sell it to somebody else. They have to be able to do whatever they want with it. And that has presented problems over the years. We have what we call crummy provisions so that you can gift into a trust and still have it be in the trust. We have all of these issues. But the common one is to gift it to is to put the equipment or the money or whatever it is into an LLC, usually now today, or a company. Family limited partnership was the old way of doing it. Put it into the LLC and have it be a gift to the kids. How do you do that? Well, to begin with, we have to have the child have unfettered control or it's not a gift. If I have given all of the stock away or all of the membership interests away to the kids and then I move the property into it, they don't have unfettered control over that piece of equipment or the money or whatever it is I put into the company. The company has control over that. So it's not a gift. You violated the rules of a gift by doing that. How do you do it? What you do is you set up the company, the LLC, you get all of the membership interests or the family limited partnership. You get all the limited partnership interests. Then you move the piece of property, could be a building, could be a piece of property, could be a piece of equipment, could be money, could be whatever. You then move that into the company. Well, no, we don't even want to do that, do we? Let's set up the company. Then you move the piece of property into the company and you get the membership interests in return. That's the way the IRS wants to see you do it. Because that is, you know what a 1031 exchange is? We're exchanging property and there's no tax. Depending upon whether it's a corporation or a partnership or whatever it is, this is an 831 or a 931 or 941, I think it is. Anyway, it's an exchange. There's no tax because you moved the property into the company and you got the same value back from the company in stock. We just changed the nature of ownership. Now, once you've got the membership interests or the stock or the limited partnership interests in the family limited partnership, you can now give that stock, that membership interest, that limited partnership interest to the child or the mom and dad, whoever you want, me, and they have 100% control over that piece of property. It's theirs. Now we've made a gift. And the neat thing about it is, if I put $1 million piece of property into the company, I can give away little pieces of this stock that I got in exchange for putting the $1 million piece of property into the LLC or the whatever, I get the stock back and I give little pieces away, and I can stay under the exclusion amount, the exemption amount. You're exempt if you give $15,000 or whatever it is. Look it up, it changes each year according to the cost of living. It jumps in $1,000 increments, so it doesn't change every year. But I can give little pieces of the stock away, and I can stay under that exclusion amount or exemption amount. So I can give little bits away, or I could give it all away at once and just take my hit on the gift tax return. But now I've given a gift, and the IRS wants to see it done that way. You put the piece of property in, you get the stock back, then you give the stock away. That's a gift. Setting up the company, giving the stock away, then moving the piece of property in, that's not a gift. You lose. That's a taxable event. So, this is Lee Phillips talking about how you physically make a gift through a company.